Kaiser example on asset depreciation estimates. And we will ask on what adjustments will be required if the aircraft depreciation were computed using an average life of 25 years and salvage value of 5% instead of the reported 12 years and 15%. And then later on we'll show the adjustments to the 2011 and 2012 balance sheets and the 2012 income statement. So the first thing what we did was to calculate the new depreciation rate, which is due to the change in average life and salvage value. The new depreciation rate is 3.8%, and as compared to the previous depreciation rate of 7.1% as given in the question, the new rate is significantly lower. So using the new rate, we calculated the new accumulated depreciation, which is done so by taking the average age of the aircraft, which is given in the question, multiplied by the original aircraft cost, multiplied by the new rate, which will give us 6565.7. And the original accumulated depreciation is given in the question by 12,238 euros. So the difference in accumulated depreciation will translate to an increase in NCTA on the balance sheet in 2011 and 2012 of 5672.3, which is shown in these balance sheets over here and over here. Next, we will calculate the offsetting increase in detail and equity. So there will be an increase in detail by 1418.1. And this is calculated by taking the tax rate of 25% multiplied by the change in NCTA, which will give us 1418.1. There's a higher detail recorded because lesser tax was paid previously due to the higher amount of depreciation expense recorded, and hence we need to increase the deferred tax liability. And next we have to increase shareholders' equity by 4254.2, which is 75% multiplied by NCTA. And shareholders' equity will also be higher because lesser earnings were previously recorded due to the higher amount of depreciation expense recorded previously. So shareholders' equity will be increased. And these two values will be reflected here in the balance sheet of both 2011 and 2012 under point note number 2. So it will be repeated in both balance sheets. Next, depreciation expense will have to be reduced to reflect the lower depreciation for the current year, which is 2012. The new depreciation expense is calculated by using a new rate 3.8% multiplied by the aircraft cost and the value of new aircraft purchase, which is 800, and hence the new depreciation expense is 890.6. So the difference between the new and the old depreciation expense is a decrease in cost of sales of 776.4 euros. This decrease in cost of sales is reflected in the income statement of 2012. And it is also reflected in the balance sheet under non-current tangible assets due to a decrease in depreciation expense. And moving on, because of the decrease in cost of sales, the tax expense in 2012 will be higher, and it will be higher by 192, which is the tax rate 25% multiplied by the change in cost of sales. And this increase in tax expense is reflected in the income statement of 2012, and it's also reflected under deferred tax liability in 2012, because this tells us that we have a higher tax expense to pay. And lastly, the net effect of adjustment in both costs of sales and tax expense gives us an increase in profit in 2012 by 577. So this figure is reflected under the income statement of 2012, and is also reflected under the shareholders' equity in 2012 as an increase in profit. Yes, so with that, these are all the adjustments needed for 2012 and 2011 balance sheets, as well as the 2012 income statement. Thank you.
Okay, so now I'll be going through question 2. What interest rate does Aho use to capitalize its finance lease? So firstly, we have to find the interest expense in the first year, and that would be the difference between 165 and 67, which is the future minimum lease payment and present value of minimum lease payment respectively. So therefore we get our interest expense of 98, and we are given the total present value of the lease liabilities to be 1225, and therefore our interest rate would be 98 divided by 1225, which is interest expense divided by total PV, giving us a value of 8%, which is therefore the interest rate that a whole uses to capitalize its finance leases. And so now moving on to question 3. The question part A asks us, record the adjustment to a whole's balance sheet at the end of 2013 to reflect the capitalization of operating leases. And the interest rate we'll be using is 7.5% because the operating lease is capitalized, and therefore we can use the finance lease interest rate. So now we'll be looking at this table here, which would give us the present value of 2014 and 2013 lease liabilities respectively. So to find the present value, we get the value of 768, which is within 1 year, divided by 1.075, which is the interest rate plus 1. And therefore this gives us a value of 714.42. And to find the rest of the present value for the rest of the years, we first assume that for year 2 to year 5, the lease payments are equal. And therefore, for each year, the lease payment would be for 2014, 614.25, and for 2013, 538.75. And therefore, we can find the present value by discounting it according to the interest rate of 7.5%. And our second assumption is that the lease payments would be constant all the way, and therefore from year 6 to year 9 we would have 614.25, because when we divide 2564 by 614.25 we get 4.17, and for 2013 we get 4.47 years, and therefore we can assume that the operating lease useful life is about 10 years, and the remainder value we can calculate it by using 2564 minus 614.25 times 4, and we get 107. And if we do the same calculation, we will get 254 for year 2013. And the sum of the present value for 2014 would be 4113.17, and for 2013 we get 3697.77. And so our adjustments for December 31st, 2013 would be an increase in assets by the present value over here, the total present value for 2013. This is because the operating lease has been capitalized and therefore becomes an asset. And therefore we have the corresponding double entry, which will affect the non-current liability. And therefore this is the answer to the question. So the adjustment would be to the balance sheet, the non-current asset and non-current liability. And now we'll be looking at the new leases entered in 2014. So this explanation will be for part B as well. So basically we can look at it in two ways, one here and another perspective here. So firstly, if in 2014 there is no new leases, then we can find that the present value of its lease obligation would be 3058.7 multiplied by the 1.075, which is the 1 plus interest rate, to give us a value of 3288.10. But then the actual present value of this obligation at the end of 2014 is actually this value over here, which we calculated previously. And therefore this means that there's an increase in the lease obligation due to new leases, which is a total of 825.07. And we have additionally we also have an increase because the actual lease expense in 2014 was 690, which is given in the question over here. However, the expected lease expense was 687, And therefore, this means that there was an increase in lease expense due to the new leases of 3. So another perspective to look at to calculate the new leases entered in 2014 would be to firstly assume that there was no leases entered into during 2014. And therefore, we can calculate the principal repayment by firstly finding the interest expense, which would be 7.5% of the beginning liability over here, which gives us a value of 277.33. And therefore, our principal repayment would be the actual lease expense 690 minus 277.33, giving us a value of 412.67. And therefore, the supposed ending liability would be this value once again 3697.77 minus the principal repayment. However, the actual ending liabilities in 2014 would be 4113.17, which therefore giving us a difference of 828.07. And therefore, there was new leases of 828.07 that was entered into. And now we'll be moving on into part B.
So for part B, we have to identify what was the impact on the income statement for 2014. So before we move on into the calculation, we have to first make some assumption for the new leases, because in this question there was no mentioning on when was this new leases being acquired. So if we actually assume that it was acquired at the beginning of the year, then we have to account for full depreciation, and if it was acquired at the end of the year, then there will be no depreciation charge, which is why we're going to take the average. So in the case of depreciation expense, we'll first take 3697.77, which is the beginning balance, divided by the useful life of 10 years, which was mentioned earlier, plus that of the new leases, which is 828.07 divided by 10 times 50% due to the assumption that I have just made. And then for interest expense, we'll take 3697.77 times the interest rate that was given in the question, which was 7.5%, plus that of the new leases, which is 828.07 times 7.5% times 50%. So if we move on into the overall income impact on the income statement, firstly, because now this lease expense of 690 no longer exists, this will actually have a positive impact on the net income, which is why it's a positive 690. And then because now this is a finance lease, interest and depreciation expenses would exist. So if it exists, means the income statement, like the net income, would actually decrease, which is why both of them have a minus sign in front of them. So then, as you can see, the negative impact from the above adjustments is more than the positive impact on the net income. So as you can see, with the increase in the negative expenses, the profit before tax will most likely decrease, and with the profit before tax being decreased, tax expense will most likely decrease as well. So basically, we have to take the sum of the above three numbers times the tax rate, which is 35%. So then when we take the sum of all the four above judgments, we can see that net income actually is negative because of the depreciation and interest expense.
Now let's continue with question 4, the last question. The words highlighted in red color are the key information in the question background, and the company has two products, ABC and XYZ. For now, we just focus on product ABC for part A. And from item 1 of the background, the main issue of the company is that throughout 2015 to 2017, the sales director did channel staffing of 1 million, 1.5 million, and 2 million in respective years. This led to this table, which are the net sales and profit after tax figures after the channel staffing. Note that the gross profit margin is 30% on average. This information leads us to part A of the question, which requires us to adjust the revenue and net profit.
Before that, just a little bit details on channel stuffing. Channel stuffing basically is the practice of the company which sends more goods to distributors in a particular year and is an early delivery of goods to the distributors. The implications on the company is that they can boost the reported sales and profit figures on that particular year, and the implication on distributors or the customers are that they can take advantage of the deal or the huge discounts offered by the company. However, one problem here is that the amount of channel stuffing could snowball year by year, and it's very hard to sustain this practice. And if the channel stuffing is stopped, the following year's sales figure will drop, which might cause a shock to the investors. And so let's continue with the adjustments. The table on top is the unadjusted figures. The unadjusted net sales and profit after tax are given in the question, and gross profit margin is 30%. So by using net sales times 30%, we get the gross profit figures for each year. And using gross profit minus the profit before tax based on a tax rate of 17%, we arrive at the expenses, which will be used later in the table below. And also profit before tax, we can arrive here. So after this, we go to the table below to adjust the net sales and profit after tax. Just to recall, in 2015, 1 million sales come from channel stuffing, and 2016, 1.5 million. In 2017, 2 million sales from channel stuffing. So how we adjust the net sales is that, for example, in 2015, because the 1 million sales was not the actual sales in that year, we minus it off. So, as you can see from the formula in the formula bar, we arrive at 15.5 after minusing off the 1 million. Similarly, for 2016, first we need to add back the 1 million, which should be the actual sales in 2016 instead of 2015. And then, similarly, we minus off the 1.5 million sales from channel stuffing. And for 2017, we do the same. And that's how we arrive at the adjusted net sales figures. And then, using the 30% gross profit margin, we arrive at the gross profit. And then the expenses were copied over from the above table. And after this, we arrive at profit before tax. And using the same tax rate of 17%, we arrive at the adjusted profit after tax. You can note here that for unadjusted figures, the profit after tax shows a decreasing trend from 2015 to 2018. However, after we adjust it, the profit after tax shows an increasing trend. And this leads us to the discussion of question B, whether it is necessary for the board for the financial restatements. Our group feel that the restatements are necessary. Our first reason is that, as we recall, before the adjustments, there's a decreasing trend of profit after tax from 2015 to 2018. However, for actual sales, the profit after tax shows an opposite trend, which is increasing. So if we don't restate the financials, it will not reflect the economic reality. And the consequence of this is that it might give investors wrong signals into believing that the firm was not doing well, and this will affect the share price of the company. And the second reason for part B is that if channel stuffing continue, there's less necessity to restate the financials, as the trend will still be decreasing. However, since they already stopped the channel stuffing, which totally affect the profit after tax figures and the trend, there's even more necessity to restate the financials. And these are the main points. A side point will be the channel stuffing is actually a fraudulent practice in the first place, because no orders from the buyers were placed with the company, and this led to the sales of the excess inventory not being recognized. And this inventory also might be returned to the company later on. So this inaccurate recording of all the financials should be solved. So our group feel that financial restatements are necessary.
So for part C, with the successful launch of the competing product for product XYZ, we estimated that sales of product XYZ for 20X9 will decline by 30%. As such, we believe that there is excess inventory, and you assume constant inventory turnover to estimate the excess inventory in its 20X8 financial statements. And also you decided on an impairment charge of 80% on the excess inventory. Show the adjustments for this impairment using the format below. So firstly, you will calculate the inventory turnover ratio, which is given by the formula inventory turnover equals to sales over average inventory. As there was no beginning balance for inventory provided in the question, we used the book value of $5 million when calculating the inventory turnover ratio. So we take $180 million, which is the sales, and divided by $5 million, which is the inventory. And we get 36 as the inventory turnover ratio. So for the newly estimated sales in 20X9, it is reduced by 30%, so it's actually 70% times 180 million from 20X8, which gives us 126 million of sales. So to calculate the average inventory in 20X9, we actually take 126 million, which is the newly estimated sales, divided by the inventory turnover ratio, which is 36, which is assumed constant. So from this, we actually got 3.5 million as the average inventory for 20X9. So from this, you can tell that the excess inventory is 1.5 by taking 5 million minus 3.5 million. And from this, we can actually decide on the impairment charge, which is 80% on the excess inventory. So this means 80% times 1.5 million equals to 1.2 million. So on the financial statements, we can see that firstly we'll be going through the income statement. So as there's an impairment charge of $1.2 million, the expenses will actually increase by 1.2 million. And as a result, as the expenses increase, the tax expense will actually decrease. And the tax was given by the question to be 17%. And so we take 17% times 1.2 million. And after rounding off, you get 0.2 million. So the net profit will actually decrease by 1 million. So for the balance sheet, due to the impairment charge, the inventory carrying amount will be reduced by 1.2 million, and due to the tax effect, deferred tax liabilities will actually increase by 0.2 million, and shareholders' equity will actually decrease by 1 million. So for part B, explain why you believe these adjustments were necessary and how they are likely to influence your financial and prospective analysis of BMS. So for product ABC, without restating the 20X8 financials for product ABC, the projected PAT in 20X9 will be lesser than that in 20X8 due to the misleading decreasing trend from 20X5 to 20X8. However, with the adjustment, it shows that there is actually an increasing trend that will be reflected, and this will result in a more accurate projection of PAT for 20X9. Also, when the 20X8 financials is not restated, the net profit margin for 20X8 is 6.48%, which is lower than 7.22% in 20X7. This may result in a wrong analysis that the business is doing poorly. However, with the adjustment, it actually shows that the net profit margin for 20X8 will be 8.77%, which is actually higher than that in 20X7. So the sales performance is actually improving, and thus this provides a more accurate conclusion about the performance of sales of product ABC. So for product XYZ, the adjustments were necessary because there was an indication of impairment based on SFRS-I 1-36. Due to the successful launch of a competing product, it is possible that part of the inventory for product XYZ has become obsolete. An impairment has to be done to properly reflect the realizable value of the remaining inventory. So as the impairment is done, current assets will decrease, and this will actually cause current ratio to also decrease. And this may actually signal problems in meeting short-term obligations. And there might be an increased risk of technical default depending on BMS loan agreements.